Section 3 dealt with overall financial reporting quality. Now we will focus on earnings quality. Keep in mind that sometimes earnings quality refers to the quality of earnings, balance sheet items, and cash flows. But in this section, earnings quality is referring specifically to the quality of earnings of a particular company. 4.1 discusses indicators of earnings quality. 4.2 deals with evaluating the earnings quality of a company, and 4.3 is a brief section that describes bankruptcy prediction models. Indicators of earnings quality. High quality earnings refers to earnings which are sustainable and represent returns equal to or in excess of the company's cost of capital. This is a high-level definition that we've seen before, and it is one that you need to memorize. In the context of high-quality earnings, there are several terms that we need to understand. The first one is recurring earnings. This refers to the earnings that are expected to recur from period to period. Let's say a company reports income of 100 million. Of this 100 million, we might have recurring earnings of 80, which are expected to continue, and 20 million might be non-recurring, perhaps because of a division that will be discontinued in the next period. So we can say that 80 million represents recurring earnings and 20 million represents non-recurring earnings. At times, what a company might do is take expenses which are actually recurring expenses and show them as non-recurring expenses. This will cause the recurring earnings number to be overstated or inflated. Related to this is the idea of misclassification. There might be certain expenses that really should be shown as operating expenses because the operating income of a company is often considered recurring. So a company might take operating expenses and push that into another category such as restructuring expenses. This is an example of classification shifting, and specific scenarios are given in the curriculum in Exhibit 7, which I would like you to read, but I'll just highlight the first one where a company called Borden, which is a food and chemicals company, classified 146 million of operating expenses as part of a special item. That special item was restructuring charges, when this 146 million should really have been shown as an SG&A expense. The next important concept is earnings persistence. This takes the idea of recurring earnings one level further. Continuing with the simple example that I just talked about, let's say that a company has earnings of 100 in a particular period. Of this 100, 20 million is clearly non-recurring and 80 million is expected to be recurring. The question now is, what is the persistence associated with this earnings number? Persistence refers to the sustainability of earnings and the persistence in the growth of these earnings. Let's say that we expect growth to happen at a 5% rate. If this probability is high that the growth will indeed be 5%, then we can say that the earnings persistence is high, and high earnings persistence would imply high quality earnings. In order to quantify this concept of persistence, let's look at a simple relationship that connects earnings across periods. Let's say that earnings in period T plus 1 can be written as alpha plus a beta coefficient times earnings in period T plus an error term. Now this beta represents the persistence of earnings. A high beta means that the level of persistence is high. Taking this idea one step further, we can say that earnings has two components, a cash flow component and an accrual component. In this expression, beta 1 represents the fraction of the cash flow component and beta 2 represents the fraction of the accrual component. It has been shown that in earnings where the cash flow component is relatively high, those earnings are more persistent. So we can say that if beta 1 is high compared to beta 2, then the level of persistence is high, which means that the earnings quality is high. I'll give you a very simple example. Let's say you have two companies X and Y. Both have the same earnings of 50 million, but company X has almost all of this 50 million coming in the form of cash sales, whereas company Y has most of this coming through credit sales, which means that it is building up a receivables account and money hopefully will be received in the future. Clearly, company X, which is getting all its money in cash, has earnings which are more sustainable. The final point to be made here is that not all accruals are created equal. We can say that some accruals are normal and other accruals are not normal. So clearly earnings that are coming through receivables are normal, but if sales are growing and receivables are going up at the same rate, then that is normal. On the other hand, if for a particular company accrual based accounts such as receivables are going up at an abnormal rate, then that would be a cause for concern. Mean reversion in earnings. The main point here is fairly straightforward. Let's say that you have a particular company or a set of companies in an industry with an exceptionally high ROE. You can take the example of technology companies in the United States in the mid-90s, companies like Oracle and Microsoft, where the return on equity was very high. Very high ROE will eventually come down to some mean or average level. Similarly, if you have very low ROE, that will eventually come up to the mean. So we will have mean reversion in earnings. This point makes intuitive sense, and there is also empirical evidence that suggests that earnings will eventually revert to some form of mean. The logical explanation here is based on what you have studied in economics. If a set of companies have very high return on equity, then other players will enter the industry, possibly undercut prices, and eventually the earnings will come down to a normal level. If the ROE is very low for a particular company, then the company might spin off or sell off units that are not making much money. Managers who are not performing well might be fired. So eventually the ROE will come up. There is also empirical evidence for this. As I mentioned earlier, companies like Oracle and Microsoft did extremely well in the mid-90s in terms of high ROE, but now their ROE is much closer to what would be called a normal level. Another important point here is the link between how fast this mean reversion happens and the level of accruals. We talked earlier about the fact that earnings has two components, the cash component and the accrual component. It has been shown that if the accrual component is relatively high, then the mean reversion happens quickly. On the other hand, if the cash component is high, then the persistence is more and the mean reversion will take longer. Beating benchmarks. In the context of earnings, there is an important benchmark called the expected EPS. If a company is announcing its earnings next week, analysts will have some expectation, and let's say that for a given company the expected EPS is $2 per share. This is now the benchmark. It has been observed that if a company consistently just meets or slightly exceeds the expected EPS, then the probability that earnings manipulation is happening is relatively high. The reason is, when companies fail to meet the benchmark, the expected EPS, often the stock price takes a beating. In order to avoid this, companies might be tempted to manipulate earnings such that the earnings are just about equal to or slightly more than the expected EPS. The final point here has to do with external indicators of poor quality earnings. The curriculum mentions two external indicators. One is the number of enforcement actions by regulatory authorities, and the other is the number of restatements of previously issued financial statements. Section 4.1 is fairly heavy in terms of learning outcomes. We have actually covered 3 learning outcomes here. Learning outcome E, describe the concept of sustainable or persistent earnings, was covered in our first 2 points. Next was describe the indicators of earnings quality, and all these in a sense are indicators. High amount of recurring earnings is an indicator of good quality earnings or high quality earnings. Persistence, so high persistence and low accruals indicate high quality earnings. There is a link between accruals and mean reversion. So we said mean reversion does happen, and the speed at which mean reversion happens depends on the accrual component. High accrual component means that mean reversion is faster, and this is learning outcome G. Explain mean reversion in earnings and how the accrual component of earnings affects the speed of mean reversion. And then beating benchmarks, this actually connects with learning outcome E. This is one of the indicators. If a company is consistently meeting the benchmark, the expected EPS, then potentially that might imply low quality earnings. And finally, we talked about a couple of external indicators which connects with learning outcome E. When evaluating the earnings quality of a company, we need to look at both revenue and expenses. Let's start with revenue. The first step here is to understand the revenue recognition policies as stated in the most recent annual report. Once we understand the stated policies, we can determine whether the actual behavior of the company is aligned with these policies. In terms of understanding revenue recognition, we should look at what are the shipping terms with customers, whether customers have the right to return products within a given period. Are these rights limited or extensive? What sort of rebates is the company offering? Whether the company sells multiple products as part of a package, and then how is the revenue recognized for the different components in a particular package. We as analysts should be very careful about the DSO trend. This is the days sales outstanding. If this is going up, that implies that accounts receivables are aging, and the older that accounts receivables become, the less likely it is that the money will be collected. So that would imply that the earnings quality or the revenue quality is low. As mentioned earlier, we should consider how much of the revenue is coming in the form of cash versus accrual revenue. And with accrual revenue, again, we need to evaluate what's happening to accounts receivables relative to sales. If accounts receivables are growing at a rate faster than sales, then that would be a cause for concern. Compare with the real world. What this means is that we should compare financial results with non-financial data that is being reported. For example, if you are evaluating the earnings quality or the revenue quality of a retailer, you can also study non-financial data such as the number of new stores that are being opened or the number of square feet that are being added, and the financial data or the numbers that are reported in terms of revenue should bear some resemblance to the non-financial data. If the two numbers, the financial numbers and the non-financial numbers, cannot be reconciled, then that might be an indication of low quality earnings. Analysts should study revenue trends and composition. A software company might sell a combination of product and services. What an analyst needs to understand is that if revenue is going up, then what percentage of the revenue is coming from the product, and whether the relative portion coming from each of these components is changing or not. And finally, it's important to look for transactions with related parties. If you are studying a publicly listed company and it turns out that the CEO of this company is also the owner of a private company, and you determine that there are several transactions that are happening between this public company and the private company that is owned by the CEO, then that would be a cause for concern. The curriculum presents two case studies of companies with questionable revenue recognition practices. One is Sunbeam, and I want you to read through the case study, but what I'll do is just share one or two important points. In the first quarter of 1997, Sunbeam included one-time disposal of product lines in sales. So that boosted revenue, and there's nothing inherently wrong with that. But the issue was that the revenue was shown as recurring revenue, even though the whole product line was being sold, and that was misleading investors. Revenue coming from a business unit that is being sold is clearly non-recurring and not sustainable, so that represents low quality earnings. Another issue was that Sunbeam booked revenue and income from sales of barbecue grills to a wholesaler. The wholesaler held the merchandise without accepting ownership risks. This meant that if the grills were not eventually sold by the retailer could return the grills to Sunbeam. So it was not appropriate for Sunbeam to book the revenue until such time as the retailer actually sold the product. Here again, the revenue was overstated. Clearly it was not sustainable, and that led to low quality earnings. The other case study is that of MicroStrategy, a software company. The curriculum points out several revenue recognition related issues, but I'll focus on the main one. MicroStrategy sold complicated corporate software, and the bundles that MicroStrategy sold included both the product and the services necessary to implement and install the product. Now, MicroStrategy's stated revenue recognition policy was as follows. Revenue from product licensing agreements is generally recognized after execution of a licensing agreement and shipment of the product, provided that no significant company obligations remain and the resulting receivable is deemed collectible by the management. I'll give you a simple scenario here. Let's say that the product was quote-unquote sold, and the idea was to implement and install this product over a 1-year period. According to the stated revenue recognition policy, the revenue should actually have been recognized once the product had been installed and implemented and the necessary service given. But instead, what MicroStrategy ended up doing was they would recognize the revenue even before the entire product was implemented for the customer. This was excessively aggressive revenue recognition, and it even violated the stated policy. For an analyst studying MicroStrategy, this would be a major red flag. There is a lot more detail presented in the case study, and I would encourage you to go through it. After looking at revenue, we move to capital expenditure analysis. The first point here is to understand the cost capitalization policies as stated in the most recent annual report. So we need to understand what costs are capitalized versus costs that are expensed. Companies might have different policies with respect to inventory. We need to understand the depreciation policies. If a company is using an average depreciation life that is longer than other companies in the industry, then we need to understand why that is happening. Trend analysis is extremely important, both over time and in comparison with competitors. Some of the most important trends and relationships to look at are shown right here. Non-current asset accounts. If there is an unusual increase in non-current assets, this might indicate that improper capitalization has taken place. We should look at both gross and operating profit margins. These trends should be compared with what is happening on the balance sheet. If we notice that these margins are improving and at the same time there is an unusual buildup of non-current assets, it could mean that improper cost capitalization is taking place. We should look at the turnover ratios for total assets. If there is a situation where revenue is rising but the turnover ratio is coming down, this might indicate improper capitalization. Recall that asset turnover is revenue over total assets. So if revenue is increasing but the overall ratio is coming down, this implies that total assets are increasing a lot, and that could possibly mean that improper capitalization is happening. We should compute the depreciation or amortization expense compared to the relevant asset base. If this ratio is increasing or decreasing over time without a good reason, then that can raise some red flags. These ratios should also be compared with competitors. The final point here is that we should look at capital expenditure relative to property, plant, and equipment. If this ratio is increasing significantly over time, that might indicate that the company is capitalizing costs more aggressively than it should. If we are evaluating a particular public company, we should look at transactions with private companies that might be owned by the directors or senior managers of the public company. The concern here is that products might be sold at unfavorable prices, which hurts the shareholders of the public company and benefits the private company. The curriculum presents a detailed case study of WorldCom Corporation, and I would encourage you to read through that case study. The main point is that WorldCom was inappropriately capitalizing certain items that should have been expensed. Section 4.3 focuses on bankruptcy prediction models. The model that is emphasized is Altman's Z-score model, which is calculated as follows. A Z-score is based on these variables, and the higher the Z-score, the lower the probability of bankruptcy. In fact, what is pointed out is that a Z-score of 3.0 or greater indicates a very low probability of bankruptcy. This material is covered in more detail in the reading on credit analysis in fixed income, and I think the reason it is presented here is that a company with a low Z-score, which means that the probability of bankruptcy is relatively high, would mean that the quality of earnings is low. So the Z-score does capture quality of earnings, but then it goes beyond that and also covers other aspects such as the probability of default. Between sections 4.2 and 4.3, we have covered learning outcome H, which is evaluate the earnings quality of a company. And here, just as a quick summary, we need to look at revenue recognition practices. If revenue is being recognized inappropriately, then that will compromise the quality of earnings. Similarly, we need to look at a company's expense recognition policies. And here again, if there are expense items that really should be expensed but are being capitalized instead, then that also would imply that the earnings quality is low. Section 4 dealt with earnings quality. We now move to cash flow quality. When we talk about cash flow quality, the focus is on operating cash flow. This is because analysts are concerned about the cash flow generated by the core operation of a company. When we say that cash flow quality is high, this means two things. Number one, the actual economic performance is good. In other words, the cash generated by the operations is relatively high, and what exactly that means will be covered later on the slide. The second point is that the reporting quality also must be high. If the reporting quality is low and the operating cash flow generated appears to be high, we cannot really trust the numbers. So high quality means both high reporting quality and high actual cash flow. When evaluating operating cash flow, we should consider the corporate life cycle and the industry profile. Think about a startup company in a mature industry. We would expect that the operating cash flow will be negative in the early years, and probably the investing cash flow will also be negative. On the other hand, once the company is established, then we would expect the operating cash flow to be positive. In fact, if we consider a mature company, then high quality cash flow would generally mean the following. The fact that the operating cash flow is positive, the operating cash flow is derived from sustainable sources. In other words, we expect the cash flow to continue into the future and grow at a particular rate. Number three, the operating cash flow needs to be adequate to cover capital expenditures, dividends, and debt repayments. And this is what we were referring to earlier when we were talking about the actual performance being good. Point number 4 is that the operating cash flow should have relatively low volatility relative to other industry participants. On this slide, we've covered learning outcome I, describe indicators of cash flow quality. Coming now to evaluating cash flow quality. Operating cash flow is viewed as being less subject to manipulation than earnings. Because of this, analysts often focus on the operating cash flow of a company, and consequently, managers might have an incentive to manipulate the reported operating cash flow. Some of the techniques that can be used to manipulate operating cash flow are shown right here. A company might sell receivables to a third party. The sale of receivables would be shown as a cash inflow, and if this is categorized as operating cash inflow, that would temporarily boost the operating cash flow. In a sense, what is happening here is that the timing of cash flows is being changed. Ultimately, if the receivables were to be collected in a later period, what is happening here is the cash flow is being brought into an earlier period. So this is a manipulation in terms of timing. Another timing related manipulation involves delaying the payment of payables. So if a certain supplier needs to be paid in this period, by delaying the payment, the CFO in this period gets a boost. There are more sophisticated ways of doing this, such as paying off the supplier through a financial intermediary, but the point is that companies can impact and influence their CFO by effectively delaying payables. Operating cash flow can also be impacted through inappropriate classification. As I alluded to earlier, it is possible that a certain cash outflow really belongs to the operating category but is misclassified as investing. Another scenario might be where a cash inflow really should be shown as investing but is instead categorized and classified as operating. So by misclassifying, a company can inflate its reported operating cash flow. A company that is trying to manipulate operating cash flow might also exploit flexibility in accounting standards. As we have studied, companies that follow IFRS have some flexibility in terms of how interest and dividends paid are classified, and also there is flexibility in terms of how interest and dividends received are classified. So a company that might want to boost its operating cash flow would show interest paid as financing rather than operating, and interest received as operating rather than investing. Accounting standards also distinguish between how cash flow from non-trading securities needs to be classified versus cash flow from trading securities. Cash flow from trading securities can be shown as operating cash flow, whereas cash flow from non-trading securities should be classified as investing cash flow. Now, clearly there is some subjectivity in terms of how the securities are classified by a firm, and this flexibility can potentially be exploited. The curriculum points out that we as analysts cannot rely on computerized models to compare net income with operating cash flow. The reason is simple. Companies that are trying to manipulate are aware of these models and will make the necessary adjustments to ensure that computerized models do not flag them. The curriculum presents a few case studies, and I'd encourage you to go through those case studies. Here are some of the major points. One case study is related to Satyam, where they had a 53 million non-cash item labeled as a gain on foreign exchange forward and options contracts. So this is a derivatives contract, and this is a huge amount associated with simply a derivatives contract, and the company is a software company. So this raises questions. For Satyam, there was a steady growth in receivables, and as we've discussed earlier, that is also a red flag. And finally, there were increasing amounts invested in current accounts. So they were non-interest bearing accounts, and that also raised questions. Another case study presented is that of Sunbeam. The fact that Sunbeam used the indirect method coupled with the second point allowed Sunbeam to overstate CFO in 1997. Essentially, in 1996, the restructuring charges were overstated, and when these were reversed in 1997, that caused the CFO to be inflated. The details are in the curriculum. Also, Sunbeam recognized revenue on transactions which lacked economic substance. The third case study is that of Nautica Enterprises, and the main issue there was shifting cash flow classification. In other words, the cash flows were not appropriately classified. Over the last couple of slides, we have covered learning outcome J, evaluate the cash flow quality of a company. We now come to the balance sheet. High quality here again has two dimensions: high financial reporting quality and high financial results quality. In terms of financial reporting quality of a balance sheet, there are three important attributes: completeness, unbiased measurement, and clear presentation. By completeness, we mean that items that should be on the balance sheet are presented on the balance sheet. In other words, if there are several off-balance sheet items, then that compromises the completeness of reporting. A classic example of an off-balance sheet item is operating leases. If a company has several operating leases that represent a substantial liability, then that compromises the quality of the balance sheet. Unbiased measurement is also important. There are several items on the balance sheet where the valuation is subjective. In those cases, the value shown on the balance sheet should be as unbiased as possible. Items where there is some subjectivity include impairment charges. At times, long-lived assets should have more impairment than is shown on the balance sheet. Another item that might be overstated is goodwill. Clear presentation refers to how well and how clearly information is presented on the balance sheet. While there are accounting rules which define how information needs to be presented, but companies still have some judgment or some discretion with regards to what information to consolidate and what information to show separately. Also, companies have some discretion in terms of the details that are shared in the notes. Clear presentation means that the information is presented in a way that makes it very clear to the reader of the financial statements. In terms of high financial results quality, we are looking at these three major items. Is there an optimal amount of leverage? Is there appropriate liquidity? And does the company have an economically successful asset allocation? The curriculum does not get into details here, so as long as you know these major bullet points, you are in good shape. What we've covered here is learning outcomes K and L. Describe the indicators of balance sheet quality and evaluate the balance sheet quality of a company. Section 7 deals with the sources of information about risk. There are several sources and the major ones are shown right here. A company's financial statements are a major source. One might think that the auditor's opinion would be a useful source of information about risk, but the curriculum points out that this is not necessarily the case. The auditor's opinion gives information about what's happened in the past, so it is looking backwards. Risks, however, deal with what might happen in the future, so we need to go beyond the auditor's opinion. Companies are required to report risk-related disclosures in the notes, so these need to be studied very carefully. Often risks are mentioned in the management commentary, also called management discussion and analysis. There might be other required disclosures that can be studied. And finally, we can look for reports in the press about possible risks associated with a company. Here we've covered learning outcome M, describe sources of information about risk. That brings us to the end of the reading. Make sure that you can say something sensible about each of these learning outcomes. I have gone over some of the examples very briefly. What I would like you to do is read those examples carefully, because the concepts that we have discussed are applied in the examples. Also do the practice problems at the end of this reading. That is it.